Tesla destroys the S&P is the focus of our talk today. This is Greg for Teslafaninsight. Thanks once again for joining us. I'm in Atlanta, Georgia. Happy to be at the hotel. We've listed where on the image. We want to first thank our Patreon supporters as well as our subscribers. If you enjoy the show, please take time to like and subscribe. We're trying to use the natural light here because I don't have additional lighting, and we appreciate your indulgence today. So there's the first item I wanted to mention is one of the companies we trade a lot is Shopify, and they just announced earnings this morning, which were good. I think they exceeded by 20% the revenue target. So as a result, the stock is up a nice $70 today, maybe $80, and we think it's going to be up another, $150 over the next 2 or 3 days. Something to think about. And back to our Tesla circumstance. So there's a problem that's popped up between Tesla and the S&P that we think is noteworthy. What that is that, I'll give you an example. There's a company called Fidelity or Rowe Price. In this case, let's take a look at Rowe Price, one of the largest investment managers in the world. So Rowe Price, if you type in Tesla, if you type in Google Finance, and then when you get there, you type in Tesla institutional holders, they will actually drop a list down to you of all the large institutions which own shares in Tesla stock. So there's an interesting problem that's kind of brewing, which we're kind of concentrating our show on today, reflective of our idea that will Tesla actually blow up the S&P? So what that is that if you look at the numbers, there's an interesting challenge that happens. So let's say you're a fund manager at Fidelity or Rowe Price. What happens is that your job is to invest along the parameters that were described when you issued your documentation. The nightmare or challenge that's popping up is that, let's say you're a fund that does what's called big cap growth. So it's a short term for the investment management business, which means big capitalization growth companies. So what happens is that someone will put up a screen and say, I want to know all the big cap growth companies out there. And then they bring up a screen, and then you can see what those companies are that are big in capitalization, and they're growing rapidly. Why are we focused on that as a category? Because it turns out that any company that's growing has a higher stock price and an increasing stock price in ways that companies that are not growing do not enjoy. So big cap growth is a high number of entities, probably thousands of different funds that are focused specifically on that. Now, one of the most important growth areas out there is actually technology. So there'll be a fund whose name is Big Cap Growth. Then there's another fund called Big Cap Tech. And so now you have another segment, but technology is growing faster than sort of any other part of the market. So usually individuals and institutions chase good returns. And so when you have companies within that big cap tech growth space, that's another fund type where there are hundreds of them that are out there that are trying to differentiate themselves by identifying growth companies in the technology space that are big cap. Usually there's an emphasis on big cap because if the company has a large capitalization, it's easy for that fund to trade in and out of it. Whereas if you have what's called small cap, usually you're under $1 billion, let's call it $500 million. Those companies do grow rapidly because they're smaller, but they have disadvantages in that trading in and out of them easily, et cetera, can be a challenge because if you're a big fund with large amounts of money to trade, you have difficulty both identifying these companies as well as trading them, because when you put the type of money in that those guys bring in every month, it just creates chaos. So I'm bringing all this up to you because obviously in this case that we're getting to, Tesla is actually what's called big cap growth in technology. And then there are screens that fit Tesla. For example, there are entities that want auto companies. So you could even keep changing this around to say, let's add, say, big cap growth in autos. That category isn't a heavy one because most of the major auto companies are fairly staid. And so not a lot of investors would actually go after that category. So what we wanted to bring out as a question mark for today regarding Tesla is that there's an interesting problem, which is, let's say I'm at Fidelity and there's a group of offices on either side of the hallway. And as you walk down that hallway, there are managers whose job it is to specifically focus on certain investment zones, if you will. So this is a very interesting situation because if you look at it, there's a group that's in charge of managing what's called S&P index funds. So there might be more of a computer with less of a staff because it's defined what they're going to invest in. But this group of people is laser focused on, hey, how do we invest efficiently so that we can focus on the S&P? So there's a problem that showed up, which is in the case of the S&P funds and how they operate, they have to concentrate on S&P selected companies as they invest. All the other funds, so for example, if you have a big cap growth fund, it can invest in anything it wants that's growing that's big cap. Technology funds, similar idea. The problem that happens though is that Tesla has not been sitting in that, call it, I'm seeing all these numbers, so let's call it $20 to $30 trillion worth of money, where Tesla gets theoretically 1 to 2% of that once they enter the S&P. So all of that money, because Tesla's not in the S&P, has not been coming S&P towards Tesla to date. So the reason why we named this show, Will Tesla Blow Up the S&P, is that we're hearing numbers like 200 million shares, a large number of shares that are out there that are needed for different funds across the spectrum to become S&P compliant once Tesla enters. So we then have this sort of very interesting, weird question. Let's say you have two fund managers, right? There's one fund manager on one side of the hall, and there's another fund manager on the other side of the hall. The guy on one side of the hall is investing in technology, big cap growth. Tesla is a great example. He owns a lot of shares of Tesla, thousands of shares as part of his fund's allocation in that space. Across the hall from him is a guy that's supposed to manage their S&P sort of allocation, percentage of stock that we control and own related to the S&P. So the problem that's coming up with Tesla is because right now, just to give you raw numbers, 60% of shares are institutionally owned. 20% is actually owned by Elon personally, and then you have large holdings by other executives and venture guys. So Elon's crew, if you will, owns 25% of the company. So what this creates is very small amounts of float or non-owned by institution shares that are traded daily as you see the stock move around. So the problem that's kind of popping up as a question mark is, once Tesla enters the S&P, where do we get shares? So if you go back to our analogy, the question is, if you have two fund managers who live across the hall from each other, the index managers have to buy the shares. And the guys that are already in it aren't selling their shares because they know the company's doing well, they want to own it. So this really, really weird question pops up, which is, how much does the marketplace have to offer to cause the big cap growth manager to say, look, we've made so much money here, the fundamentals no longer fit, and we're willing to sell out? So this is where the problem pops up, because you already have small float, and you already have large institutions already own it. So you now have a negotiation that can happen in the hallway of Fidelity, which is, okay, guys, how are we going to do this? S&P has to have those shares. You guys currently own those shares. At what price do we have to raise this stock to get you to sell out? Now, in theory, there is a number. So the way this works is you basically look at the growth rate of the company to determine where we are. There's a difference between the current growth rate and the anticipated growth rate. So in essence, these guys are using computers to determine what the current and over the next few year future earnings growth is for Tesla. And we all know that if you take the growth rate times the amount of earnings, that equals the stock price. So the higher the growth rate, therefore your earnings will increase as well. That's the general formula that people use. And so there's a debate that people have, which is, okay, at which point do we sell? Because the price that we're getting for the stock so far exceeds the growth rate and earnings of the company that we want out. And so the reason why we question whether or not Tesla blows up the S&P is that you have all this weird dynamic of the fact that most of the institutions that currently own the stock will have to buy it kind of for themselves across the hall. So they could skip selling it into the market, find out what the market price is, and simply sell it between each other in the hallway and skip it ever entering the marketplace. Now this is, I just thought that was kind of interesting because I think it's against the law. In theory, they do have to sell shares and then buy the exact same shares back in the fund across the hall. And there's no choice because it avoids one fund and its investors not making as much money as they should, even if they're selling back to another entity across the hall. So it's an interesting, I think it's a fascinating problem because, it's almost a waste of money to use the marketplace here, but I think it's actually mandated because you have to have transparency relative to investors. So where we think this wrecks the S&P is that if you think about it, as that stock price continues to rise, the rising stock price makes it a larger percentage of the S&P, which increases the allocation. So in theory, you could have this back and forth where they're trying to figure out the price to go to. As the price rises, the S&P allocation percentage rises. So you could have this sort of tit for tat where just the S&P itself forces the stock price higher, which increases the allocation that they have to make for the stock. Now, obviously, I think what this creates is a spike in the stock price and then it sort of comes back down. But the problem is it's interesting how it happens because with a shortage of shares, the marketplace determines by supply and demand what the price is going to be, which is why Delta on Tesla is so high and everybody is sitting there going, this is going to be real interesting to see how they work this out. And if you own the shares, the amount of money that you make could be rather severe. So I'm happy to answer questions, et cetera, but in essence, the big problem that's lurking is large institutions already own the stock and there isn't a lot of more stock to buy. So not only do you have it already allocated to the institutions, but there's constricted supply as the new buyers decide to come in. So what does all this mean? Well, I think that if we were being speculative, we could argue that double the amount of money is coming in to buy Tesla's shares that currently exists. And so by supply and demand, just basics, that's a 100% gain in the stock price on entry into S&P. And then as this price rises, S&P has to buy more. So I'm arguing that there's a question, does Tesla actually blow up the S&P? And the question is driven by what's going on here back and forth on pricing. So there's an answer that's going to come out, and there may have to be special process for how Tesla's brought in. But it is a really fascinating situation. And for me, when I look at options on this whole thing, I don't think if you're a regular investor, you can afford not to have one option ownership of Tesla for the next 6 to 8 weeks as S&P works out their thing. And the reason is that it's entirely possible you could buy an option for $2,000 or $3,000 that becomes worth $100,000 in an extremely short period of time, hence the high delta Tesla currently has. And the reason is what I just described. This whole process of supply and demand is totally screwed up by the dearth of supply that's associated with Tesla. So I look forward to, the answer to this is we're going to see how the marketplace plays it out. I just, a disclaimer for those of you who hate logic or don't like me, that's fine. You don't have to send me the flaming email. Think through the logic and then articulate whether or not it's a fit for the data, and then we go from there. At any rate, I wanted to review all this with you, and on cue here. At any rate, I want to thank you for taking time out to join us. This is Greg for Teslafaninsight. Tschüss, macht's gut, au revoir, lehitraot, choda hafez, hey do, zdravstvuyte, ni hao ma, and assalamu alaikum. We look forward to your comments. Have a great day. Bye for now. And thanks for joining us. Don't forget to like and subscribe. Thanks and have a great day.